This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 322. Ready for Austerity 2?
You buy long-term securities, you drive up their price, you drive down their yield.
My colleagues and I are acutely aware that high inflation imposes significant hardship.
The stock market is doing extremely well, which means to me jobs.
Because we inherited a bunch of formulas from the Labour Party that shoved all the funding into deprived urban areas.
All of their red ink is really our black ink.
This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
Now, are you ready for Austerity 2.0? The UK, it seems like the most likely way forward there, with a new Prime Minister who's going to promise fiscal conservatism. That's the term, isn't it? Which means balancing the books, making sure that government debt doesn't grow. But is that how you get out of a downturn, really? And just how important is it to balance the books? I mean, surely you need some sort of control on government spending, but exactly how does government funding work? This week we ask, is there a way of avoiding yet more austerity? Wherever in the world you are. That's this week. Well, it seems likely Britain and probably most places are going to have to get used to the idea over the next year or so of more austerity, more cuts to government spending, possibly higher taxes, less money in people's pockets, in other words, and less government services, because that will supposedly fix things. Of course, Steve, the reason given for austerity is we've got to control that public sector debt. With the reasoning is that it becomes too large. Well, what happens if it does become too large? Is that the risk of default? Well, that's not going to happen in a place like the UK, is it? But there is that concern, isn't there? And we've seen that in the UK recently, that it will drive away foreign investors from buying up government bonds. And the UK's had that very recent experience where we saw bond yields shoot up as Liz Truss and Kwasi Kwarteng started sort of proposing tax cuts that would see the public borrowing increase. So, I mean, that is a real concern, isn't it? Because there is a link here. We can't ignore the money markets.
Well, that sounds to me a bit like a primary school teacher saying, I can't ignore the kids. True, but you've got to be the one handing out the discipline. And what throws me about this is that it comes down to what the school teacher wants to have happen in the classroom. And in this particular case, the school teacher, when the school, my analogy, of course, is to the Treasury and the central bank as the school teacher and the bond market as the kids. The school teacher controls the flow of money, of finance, that enables them to buy the bonds in the first place. And this is the accounting detail that means that really the interest rate that's set on the bonds is entirely, at least the bonds the government issues and sells to back its deficit, is entirely up to the government. It's not something that the market itself can control. They can set the price in the secondary market at some point, but the initial offering for those bonds, and therefore the interest rate that is paid on that bonds, is a policy decision for the government.
But in a situation where there's lots of bonds already out there that are changing hands, so if the government says, we're going to issue bonds which are going to pay a very low interest rate, there's not going to be a great deal of interest if people are going, well, look, we're selling bonds with much higher yields because you're issuing too many of them, so the yields are going up. I mean, they don't work in isolation from what they've already issued. People are buying and selling these bonds every day. There are two
different funds that are involved in buying those things, and this is why it gets to be ridiculous. Because again, this is why if you don't have a double entry bookkeeping view of this stuff, you're talking through the wrong orifice. Okay, and that is, most economists, I don't know if they use an orifice. They talk through the side of their skulls. God knows,
right.
But they don't.
In that case, for the rest of this podcast,
yeah?
I'll just turn around.
There you go. Yeah. You'll be pointing in the right direction. Stand on your head as well.
Yeah.
So when the government issues bonds and it's sold into the primary dealer auction or the first purchase of bonds, where you've got to be accredited by the Bank of England to be able to take part in it, that all appears on the asset side of the banking sector's ledger. And when you look at what the deficit it does as a process of money being created through time, when the government spends more than it gets back in taxes, and it almost always does that. It's extremely rare to run a surplus, and normally what happened after it was a depression. So we'll come back to that later. But when the government spends, and it already has money in its account at the central bank, and a substantial amount of money. In the case of the UK, I just looked at the figures a few days ago, and it's got something of the order of 1 or 2 years' worth of deficits in its bank account at the Bank of England. So that is. So that's got money to pay for initial spending without worrying about whether it sells the bonds. When it does that initial spending, it's putting money that goes into the bank accounts of individuals, you and me, and companies and so on, government spending, welfare payments, etc., etc. That's on the liability side of the banking sector's ledger. On the asset side, that turns up as additional reserves for the banking sector. Now, normally reserves used to run at trivial levels because reserves earn no interest for banks, and they therefore get them at the absolute minimum level they could. Through QE, those reserves are now huge.
Yeah.
Now, reserves used not to earn an interest rate. Now they do earn an interest rate, but that interest rate is set below the interest rate on bonds. And it can be something like about a 0.1% difference. So you get paid.
Although they do issue index-linked bonds as well, of course, don't they? And that actually is why a lot of the government debt that they're having to pay back is because of those index-linked bonds. So a lot of the payments they're having to make out are because the interest rates have gone up so much.
Which then means they've actually changed where the government creates money, which is another stage in the whole process. But the actual purchase of the bonds is done using funds. It's not money, because money, money you can go down and buy yourself a beer at the local pub. If a bank tried to go and buy a beer at the local pub using reserves, they're breaking the law. I'm not saying they won't do it, but that's the consequences. So you can't use reserves for anything other than a narrow range of purposes. And one thing you can use it for is buying government bonds. Now, if you're getting, let's say you're getting 2% interest on the reserves and the bonds are offering you 2.1, are you going to buy? When that 0.1 is of the order of, half £100 billion, yes, you will. It's a substantial amount of money. So that sale into the primary market is guaranteed. The next stage is to the point where it equals government, it equals total reserves in banks, presumably. I mean, once banks have changed all their reserves for government bonds, they can't keep doing that. And why would we have foreign investors buying it? If that is the case, because about a third of all bonds are foreign investors, why would foreign investors be buying up those bonds? I guess they're buying them on the secondary. They're buying on the secondary market, and you get all the usual speculation that goes on in the bond market. But the actual provision of funds that enables the government not to spend in the first place, but to make sure that its spending doesn't turn its account at the Bank of England into an overdraft account. That's the function that the bond sales have.
But it's when it goes onto the secondary market that's where the problem starts, though, isn't it? Why if banks are on such a good deal, they're getting a payback on more than holding cash, which is doing nothing for them in reserves. So they buy the bonds. Why would they sell the bonds? Why wouldn't they just hang on to them? Why do they go into the secondary market?
That may be something we see a dramatic change to if the government issued bonds which gave a much lower interest rate than bonds trading on the secondary market on the liability side of the banking sector's ledger. If that happened, then quite possibly the banks wouldn't sell them. They'd be taking too large a capital loss. But there is no way. The only way the banks can avoid buying the bonds from the Treasury when they're issued specifically to cover the deficit and are sold into the primary market is if they're willing to turn down, let's say the difference is Is like, if it's what they say, a 1% to make it easy, and the bonds are £1 trillion, so they've got to turn 10 billion pounds a year. The banks aren't going to do that. They'll take it up. So the actual sale at the primary market is not a problem. What happens on the secondary market, that is another issue, but that doesn't change the amount of money the government is up for in paying the interest bill on bonds, because that interest bill that's given by the nominal amount on the bond. So if the bond promises 3% interest on £1,000, then you're going to get 30 quid a year no matter what. And then if that bond gets sold on the secondary market for half the face price, then your notional yield is 6%, but just the amount being paid by the British Treasury, it's still the same amount of money.
But then when they issue more debt or issue more bonds, the expectation is it's going to be that 6% though, and that's where. So it's not on that first issue. It's in the subsequent issuances where the servicing cost becomes higher.
What again? I'm going to use my primary school analogy. What they're doing is they're letting the bully in the schoolyard determine what happens inside the classroom.
Right.
Okay? I like this analogy. I might write a paper on that.
Well, we'll stick with that one. Yeah.
Okay.
So what you're saying is So the bonds are trading on the secondary market with a yield of 6% of whatever the maturity. 6%. The government says, well, okay, we currently they might go, well, we've got to issue bonds with 6% because that's where the market is.
And that's what I'm saying. They don't have to.
No, I'm saying that's what their conventional thinking is. What you're saying is no.
That's right.
Maybe they should come along and say, well, no, stop that. 3%. But then who's going to buy them?
Well, who cares? I mean, the thing is, bank sales of bonds to the secondary
market.
Someone's
got to buy them, otherwise they've got debt that they're not meeting, haven't they?
No, the bonds are still owned by the banks.
Right.
I mean, if the banks are getting, well,
the banks have to buy them in the first place, though, don't they?
They're buying them using the funds in the reserves created by the deficit.
Right, but can't they buy? And they can't buy from the secondary market, couldn't they? So if you're a bank,
they buy and sell to the secondary market, sure.
Right.
But
my point is, if you've got a swag of bonds, and there's one thing, there's lots of bonds around, and if there's not enough in the UK, go and buy them from somewhere else. But so if a commercial bank is sitting there and saying, well, okay, we could buy newly issued bonds 3% from the government, or we could buy bonds which are quite cheap right now. They're giving us a 6% yield. You'd take the 6% yield, wouldn't you?
How do you get it? How do you pay for them? Okay. Now this is the thing. You've got reserves that there are limitations on what you can buy with those reserves, legal limitations. It's got to be something that's happening on the asset side. The banks can buy bonds off the non-bank financial institutions predominantly on the secondary market, buy and sell those. They're doing that all the time. But when it comes to the reserve, they can't use the reserves directly for that. So if they have these excess reserves and the government says, here's a 3% deal, this is inside the classroom, and you're saying, but if I go out into the play yard, Bully Jack is going to give me 6%. You say, well, okay, you don't get what's in the schoolyard. Then go and do what you like during playtime. But in the schoolroom, in the classroom, I've given you a billion. Let's say I've given you $1 billion in reserves. Okay, and I'm going to pay you nothing, just to make it simple, nothing on the reserves, and I'm offering you to buy bonds from me. They're going to give you 1%.
Yeah.
Are you going to?
Yeah, of course.
Take the
of
deal?
course.
Okay. Yeah. Okay. So then you can go into the schoolyard and decide whether you get involved in the trading with Bully Jack. Okay. But it is a separate process to actually get those bonds sold to cover the deficit itself. And all this hysteria is saying that if the government doesn't match the interest rate in the schoolyard, then it won't be able to sell them inside the classroom. That is wrong. If you sell in the classroom, you get whatever rate you offer. So long as it's, if you offer a higher rate than you get on reserves, you're going to sell them.
Right. So you're saying when the Bank of England stepped in, when Liz Truss and Kwasi Kwarteng, do you remember those two? Ancient history now. When 30-year yields shot up, when they said, okay, we're going to fund tax cuts by borrowing more. and making the rich richer. 30-year yields, they went from about 3.5% or 3.6% to almost 5%, sort of like almost overnight. And then the Bank of England panicked. They started buying them up because they wanted to get those yields down. Didn't work for very long, by the way. They went back up to get 5% again. It wasn't until Truss and Kwarteng, we realised that partnership was dead, then that those rates started to go down. Your point is that we should have just not worried about that and said, well, that's the vagaries of the second market. Let them do what they want. So why would the Bank of England be worried about it then? Why did they step in? Why wouldn't they? Well, because we all look at that 5% and think that's what our mortgage rate's going to be. Because I guess that's because that is determined by the secondary market.
The bank wants to drive. Again, this is where you get neoclassical theory and ideology getting in the way. The bank wants to drive the interest rates up because they believe that they've got to reduce inflation, and to reduce inflation, they've got to put the interest rate up. So, in that sense, even though, I'm very critical of the management of the bank. I don't know how many of the people I used to work with in the research bar section of the bank are still there and still able to do the fairly innovative research they were doing back when I was in London from 2014 and so on. But the top management just basically swallowed the neoclassical textbook, and they think if it's 5% in the market, we've got to match it. No, it's a separate market.
Right. Okay. Well, that sort of makes sense, but I'm just wondering whether one does influence the other, doesn't it? So when interest rates shot up to 5%, there was that big fear, wasn't there? That that 30-year rate is largely being used to determine what the rate we're paying on our mortgages is. Is it right to draw that conclusion? And because that's what. The banks themselves, the base rate they get paid is one influence. The cost of they've got cost of funds elements to them, but a lot of the setting of interest rates is quite arbitrary. Actually, Marx had some wonderful stuff on this back in the third volume of Capital, saying from his reading of the interest that it's totally arbitrary what the interest rate is. It's not. Again, we tend to think in supply and demand versions. If we're going to supply more to the market, then the price has got to fall, which is the bond price, therefore the interest rate rises. No. It is the two totally separate mechanisms to begin with, and then the interest rate the banks themselves set can be quite arbitrary as well. Right, but the higher those rates go in the secondary market, the higher your mortgage rate will go as well. Yeah. So that's a concern then, isn't it? If you've got, say you've got interest rates on the secondary market running at 5 or 6 or 7%, they're going a bit crazy. And the government says, well, but we've got to spend more. We've got to keep on spending because these are difficult times. We're going to issue even more bonds onto the market. But we're only going to pay 1%. So the banks get them for 1% and they go, we can offload these onto the secondary market and make a killing because as we know, there's more bond. This government's going spending crazy. So there's going to be more bonds coming our way. We'll just keep on getting them and then send them on to the secondary market. That is just going to inflate those secondary market yields higher and higher and higher, isn't it? Well, you've got, if you're getting bonds at 1% and they've got a face value of 1,000 and you try to sell that bond into a market where the yield is 6%, then the face value has to fall. In that case, the banks aren't going to be able to sell them. Yeah, and that'd be a tragedy because they'd be forced to keep them on their books. Well, whoopee-doo. It doesn't make any huge difference to the government. The whole thing here is do high interest rates cripple the government? Do they force the government to spend less on other activities? And the answer is absolutely not. The government does not borrow money, and this is the point. The government creates money and then changes how it's backed. Right. Okay. So quick question before our break. And by the way, if you are a subscriber on Patreon, there is no break. But for the rest of you, no ads. Yeah. Okay. No ads. So, but before we get to that, given that, and that all makes perfect sense. So treat the secondary market and the primary market very differently, and the government doesn't need to kowtow to the bullies in the playground. Yeah. Yep. Why is that just not happening around the world? Why are governments not saying go? Because they do, don't they? They follow the market. They don't realise they're the school teacher. Okay. Right. They think they're one of the kids. Every country around the world doesn't realise that. That's a common failing. Yes, that's true.
a common failing because they all get brainwashed by neoclassical economists.
Right.
And I've had it up to here and beyond with the tribe because they've got, the joke of the Nobel Prize they gave out a couple of weeks ago, Bernanke and friends, helping us to understand financial markets, when none of the three had money or banks or debt in their actual models for which they were awarded the Nobel Prize. So the level of asinine understanding of banking and finance that comes out of doing an economics degree is huge. And because most people, they swallow this stuff and they're just living the textbooks in the non-textbook world.
So your answer to austerity is, and we'll come to, just how much government should and we'll use that word borrow just because it's easier, the amount of money that they should borrow should not be determined by interest rates at all. They should just carry on issuing at a low rate of interest, issue bonds that they see are necessary. Well, look, when we come back, we'll look at how many. Is there a stage where it just becomes too much? But we'll look at that next on the Debunking Economics podcast. Back in a second.
This is the Debunking Economics podcast with Steve Keen and Phil Dobbie.
Okay, so Steve, one of the reasons for austerity is this argument that if you issue too much money and you see interest rates go up, then the cost of borrowing goes up, and therefore we are passing on the burden of today's costs as a burden to future generations who are going to have to pay for it all with these higher interest rates. Now, we've already talked about how, that's not the case. We don't have to be too concerned about high interest rates. That's a secondary market thing, and governments can continue issuing at lower rates in the primary market. But there is still that question about how much do they spend? Is there a healthy ratio between how much a government actually spends and, how much it borrows in effect? So that difference between, what they're getting in tax and what they're spending. So in August, for example, this year in the UK, expenditure was about £80 billion. Receipts from taxes and whatever else was £70 billion. So they were borrowing, in effect, 12.5% of what they spend. Now, that
they were creating.
They were creating.
They were creating. Yeah.
Right. Okay.
And
so
that
is actually less than it has been. But isn't 12.5%? I mean, it seems like a lot. That's in effect. If you say, well, okay, we are, because that in effect is adding 12.5% to the money supply. Relative
to what? Now, you're saying that. What you're comparing is the taxes as an absolute percentage of GDP to spending as an absolute percentage of GDP. Now, the thing that actually creates money is the deficit. So it's the gap between the two that decides how much money you're creating relative to GDP.
So that would be £10 billion then added to the so it's not 12% added to the money supply because it's the difference between government spending, which is only a proportion of the total economy. But £10 billion added
would be 120 billion over a year, which is about 5% of the UK. What's the economy, about 2 trillion and a bit?
Right, so you think that's fair enough? You think that's
that's a reasonable ratio. I mean, again, the question is how much do you want the money supply to grow? Now, again, of course, I'm leaving out the whole issue of climate change, blah, 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 and growth, et cetera, et cetera. But if you're in a growing economy, then you need the money supply to grow because, again, both the only way you can have an expanding real physical output with constant or falling money supply is if prices of things are falling. You've got general deflation. General deflation only works if you don't have any debts. And we all have debt. So, in the real world, when you look at where growth has occurred in real terms, it's also been where growth has occurred in monetary terms. Finding real growth without monetary growth is virtually impossible. Now, in that situation, the question is, how does the money supply grow? There are three basic ways, and one of these is going to make one is pro-MMT, and the others, some MMTs are going to be angry at me, but this is what I think, and I'm pretty certain I'm right and they're wrong on this one. The government can create money by spending more than it takes back in taxes. The banking sector creates money by lending out more than it takes back in repayments, and a country running a trade surplus is effectively creating money by converting the excess foreign exchange into domestic currency when it's repatriated. So those are the three ways you can go about creating it. Now, the UK, I believe, is running a trade deficit still, correct?
Yeah, but by a significant margin, yeah.
Destroying money that way.
Right.
The private sector has, with interest rates
so it needs
rising,
to compensate for that then. So what you're saying is,
well, if you've got to go the other way. I mean, you've got two negative forces here. You've got the foreign sector effectively draining pounds from the UK. You have the government saying it wants to drain pounds from the UK. And then the private sector saying, you want us to borrow at interest rates like this?
Yeah, we're not going to do it. When
those three give up,
so the money supply is not. So that 10 billion that the government
the growth becomes negative. The economy goes backwards. That's your option.
Yeah, and then at the same time, pulling the other way, looking at it from the household's point of view, people are going, well, inflation is pushing interest rates up, so mortgages are going to cost more.
Yeah,
real wages aren't keeping pace with inflation, so we've got less money. The government is pushing up taxes because it's trying to reduce that. What they're saying is debt to try and get that 10 billion down to nothing. And then they're making cuts to welfare and other public services as well, and energy bills going through the roof as well. So forces in two directions. Everyone is worse off, and there's less money being pushed out into the economy, so there's no way out of it. So
that's right.
Austerity is a model for a downward spiral, which is where we're heading.
Exactly, and that's and this is why it's so frustrating. People like myself and Neil Wilson and Richard, I can't think Richard's last name, Anne Pettifor, Francis, we're watching all of it saying, holy shit, if you guys sit down and do the accounting, you realise that you're not actually borrowing, you're not on the secondary market, you don't face these constraints, and if you don't create money, then we're losing money on the foreign exchange front. The private sector is not going to borrow any more money given the inflation rate and the interest rate effects right now. Austerity is going to guarantee the economy gets smaller, and that's the opposite of what you're trying to achieve.
So those two, let's ignore the foreign dimension for it just now. Let's just look at private versus public sector. So money is created, as you say, in one of two ways. In that case, either money is created because the government is spending more than it's taking back from the private sector through tax. And so money's created that way. Or the other way is that, banks are creating money because they're lending out, which people are then investing hopefully for growth, you'd hope. Probably to buy a house, but, let's work in an ideal world where actually they're using it to grow the economy. Those two ways are the ways money are created. And so if in good times, you'd be happy to say, well, the government's actually not spending any because the private sector's creating money through borrowing. But you'd hope it would work the other way in bad times, and governments would see sense and go, well, okay, there's no money being created by the private sector because they're looking and going, these are bad times ahead. So the only way out of this is to pump prime the economy. Hey, it's our job now. This is where we step in. But unfortunately, they're doing exactly the opposite. They're
stepping backwards. Again, it's the primary school analogy I used earlier. They're being, inside the classroom, they're intimidated by the bully in the schoolyard who's not allowed inside the classroom. Yeah. And that then means, you have this depressed economy, and you're going to get a few more muggings out of that. It's watching. It's almost like watching 19th century medicine or 18th century medicine, with people putting leashes on people to bleed them, believing removing blood from them is a good idea when you're ill. Sorry. That's one of the advantages of being born in the 20th century. You didn't go through horrors like that, but we're doing it to our economy.
Then the other dimension of all of this is, well, we've got central banks looking and going, oh, we've got a lot of money sitting on our balance sheet. We're not very happy about that. We need to get rid of that. What impact does that have if they start saying, well, we're going to reduce our balance sheet? What does that do to the? It doesn't actually. Yeah. Doesn't actually change the money supply in any way, though, does it?
Well, no, it depends who they sell them to. If they sell the bonds to the banking sector, then what they're doing is the bond holding of the banking sector goes up, the reserves go down. So there's no change in the money supply there because the assets remain constant. So the liabilities, which is where money exists, don't change. But if they sell them, they sell the bonds to the
secondary
public. The secondary market, then they are destroying money now,
and pushing up yields at the same time as well, of course, because there'll be that many more bonds out in the secondary market.
Yeah, driving the price down, therefore driving up the interest rate. Yeah.
So why would they? Do they need to do it?
No,
could they? Right, they could just sit there. They could just say, well, okay.
Yeah,
let's keep it on our balance sheet, and as a reminder of COVID, and not worry about it too much.
I think COVID's going to remind it on its own volition, but that's another story, and maybe another podcast. But yeah, there's no necessity for them to do that. I mean, quantitative easing itself was the wrong policy. This is what, I'd be another reason I got a bloody annoyed at giving the fake Nobel to Bernanke, because he was one of the main exponents of it. And they actually believe that would cause more bank lending. The whole reason for quantitative easing, which is where you buy bonds off banks and off the non-bank financial institutions in the belief that that will lead to more lending. It doesn't create money for the banking sector. The reserves go up, the bonds go down, held by the banking sector, but they cannot lend reserves out. And this is another bloody textbook example where textbook economics leads the economics profession in Australia. And rather than being just a vague claim by moi, I can provide the minutes of the Federal Reserve Open Money FOMC committee, the Open Market Committee that sets interest rates and determines things like QE in America. And they were puzzled as to why the banks hadn't lent out the reserves. They can't do it, kids. Stop learning bloody neoclassical economics and learn some accounting. But yeah, so that's the first thing. Now, when they do it in the other direction to the financial sector, then when they bought the bonds off the financial sector, they created money there, but they were creating it in the financial sector. They weren't creating it in the real economy. And again, everything mainstream economics does ends up pumping up the finance sector, not the real economy. When what they're supposedly trying to do is to boost the real economy.
So what about, at the surface level argument against modern monetary theory, which is a lot of what we've been talking about today, by and large. The surface level argument is, but where's the discipline? So if the government can just keep on borrowing, then where are the constraints? There needs to be something. We have to have something that sets a limit. Otherwise, it'll all just go haywire, and you'll get government spending money on crazy things. I mean, then that obviously is a concern. If a government could spend money and it just wastes it, that's not good, because you've got an economy flooded with extra money.
Look what the governments have been doing, spending their money, and most of it's been to try to keep asset prices high.
Yeah.
Okay. Now, if I wanted to define a waste of money, that's one way I'd define it. Inflated real estate prices that are half the reason why people are having, more than half the reason why they're having the hassles renting a place or buying a place. That's been caused by government policy being directed at inflating asset markets, because they got caught up in the belief that they had to maintain asset markets high. Otherwise, the finance sector would suffer. About bloody time the finance sector did suffer.
Right, care factor zero. Oh dear, what a pity. Never mind. As they used to say, eight and a half.
You're the schoolyard bully. I'm bringing out my cane. All right.
Right.
You're not going to like this, but I am.
But I quite like that idea, Steve, that I do like a bit of discipline from time to time. Just ask my wife.
Show me some discipline.
But no, I don't at all, actually. But you can understand that argument. But also, I sort of half believe you can't. There has to be a way because how do you control what governments do with their money if there's no constraint on it? And surely that money has to be spent. If governments are forever spending more and more money just to maintain the status quo, and they're not actually spending it on developing and growing an economy, surely that's a waste of an opportunity at the very least.
Look, there's tons of waste there, but I mean, you've got to look at the political culture of the society and the education that's driving them to see whether they're going to be wasting or using money, their capacity to create money effectively or not. And the trouble is, with the whole neoliberal switch for the last 40 or 50 years, it's all been driven by economic theory, which promotes the idea that asset markets are intelligent, proper allocators of resources. And what we've got is gigantic asset bubbles in house prices and share prices, which are unsustainable. And our industrial development has been pushing us towards, again, an unsustainable use of fossil-based fuels. We're now going to if we're going to try to continue, we've got unsustainable pressure on minerals, because to try to replace the current fossil fuel run economy with a renewable means a huge load of mineral resources, which we also don't have. So it's been catatonically bad government, but it certainly hasn't been improved by the belief there's fiscal discipline, put it that way.
Right. And yet, and so fiscal discipline is interesting if you look at it comparatively. So government spending, this is pre-pandemic, I'm looking at the CIA World book. Most of these are actually from 2017, so a little bit out of date. But this is US dollars. It's nominal, so and no adjustment for purchasing parity. So, obviously every economy has different spending powers. But these figures are quite telling, and it shows, why the UK might have been in a bit of a slump for a decade. So, so spending per person in US dollars: Norway 37,000, Sweden 27,000, Australia and the United States both 21,000, the UK 17,000. So the UK has just got this desire for inflicting self-harm. It should be locked away and put in a cushioned room, shouldn't it?
Not a bad idea. Yeah, better than watching them on trying to.
17 versus 30 from UK to Norway. 17,000 versus 37,000. And yet the UK is there saying, "Hey, we need more of this. More self-harm."
It is the end result of this process is zero. Okay, because what you have is, and this is the point that I'm making using my Minsky software, which I would really love people to download and just play with the banking side of it. They don't have to learn how to do the modelling, but do the banking, because when you like the double and triple keeping, you see what is actually going to happen with this idea you might have about the money supply rather than what you think is going to happen, which almost always makes a mistake in double entry bookkeeping terms. But if you...
and don't take Steve's word for it. Go to the Bank of England and have a look at
I know,
their website where
paper,
where there's a paper exactly explaining how money is created.
By the government, and by private banks. They actually leave out government money creation out of that paper, unfortunately. But if the government runs a deficit, then that is dollar for dollar equal to the surplus generated for the private sector. And when you see what are you trying to do, you're trying to grow the economy, well, you want to have more money turning over more often. Now, what if you start taking the money out, you're going to have less money, and because there's less money, you're going to turn over less rapidly because people are going to be afraid individually about not having enough money. And this is the classic fallacy of composition problem. If each individual feels that way, then collectively the amount of money declines. The turnover of money declines even further. So you get less GDP out of the same number of pounds. And that is a game which the UK has been playing for 15 years now. And really, you go back to Thatcher days, it's 40 or 50 years worth of it. The end result is you end up with an economy with no money in it.
That then comes an argument about how the government should be spending that money that they're creating. They should actually be spending it in a way that is going to increase the velocity of money in the private sector. It should be part of their focus, shouldn't it?
And providing infrastructure that makes it possible for private sector enterprises to work,
which will then also increase that velocity of money, which has been on the slide for decades in the UK through these austerity measures. So that's the other factor within it all, isn't it? So why then, given all of that, and maybe what you're saying is we shouldn't be too concerned about the secondary market, just let the finance sector and investors and speculators carry on. Why in the secondary market did the UK get hammered so much during the Truss Kwarteng? I was going to say years, but days. During those days, why did they get hammered so much?
It's a speculative market. It's a speculative market.
Nothing more than that, because when you look, because logic looks and goes, okay, well, it's probably not good to tax to give money to the rich through tax cuts, which is largely coming from money that's been created by the government. I mean that's just awful to see that happening. But if you look at the UK GDP debt to GDP ratios, it's smaller than Europe, for example, and smaller than the United States. Why would it matter? Why be concerned about it?
And smaller than Britain's private debt ratio.
Yes.
Private debt's about 200% of GDP, government debt about 100%. You hear nothing about private debt except from people like myself and the other, realistic commentators on money. But all the obsession about government debt, when it's half the level of private debt. And private debt, you do have a obligation to pay back. You can't. It is very, very different, and that's private debt's the problem. So as usual, humans are obsessing about the wrong thing.
So rather than going through another 10 years, well, fortunately we know, of course, that in the UK's case, there's not going to be 10 years of a Tory government. There's going to be less than 2. But rather than going down this austerity road, which is just going to lead to dwindling finance for everybody, less money for everybody, less spending, less government services, just a pathway to rack and ruin. Have you heard of because of course in the past there's this thing called the Great Depression, and there was this guy called John Maynard Keynes. I don't know if you've ever heard of him, and I mean he talked about. It is a bit of a strange name, isn't it? Named after Milton Keynes, I think, in the Midlands. And
course, yeah.
he talked about, actually, I always thought that was funny, that whether it was actually Milton Keynes, just as an aside, I wondered whether that was a sort of like trying to have the balance. It was a new town, so we thought Milton Friedman, and we'll combine Milton Friedman with John Maynard
You better
Keynes.
research that one for the next podcast.
But it's not the case. It was the name of a town that was already there, so it's just
damn, what a pity.
But yeah, no, because otherwise, great name. Let's put together two conflicting economists and
name a town
create something out
them,
of create a mess out of them. His idea of pump priming. What about that? Is that the way out, do you think?
That is the way out. The government money creation would reduce the pressure for private debt. We could actually use it for infrastructure. We're going to need that desperately in terms of a climate change-oriented infrastructure over the next decade or two. And the fact we haven't done it, we're going to be paying for the price. Saving money for a rainy day does mean there's no roof on the house. Very well done. We should do that. But, instead I can just see it happening again to be back to austerity for the UK, and the downward spiral continues.
Yeah, and of course, the further that spiral goes, the more work you've got to do to dig yourself out of it. Of course, and we pay for it. People pay for it because they are, as I said, that perfect storm where your mortgage is going up, you're going to get less health care, education's going to get worse. So the future is not looking great because you're just not investing in the future. And people's salaries aren't keeping pace with inflation, and it's just not a happy place to be. I wonder how many years until there's a revolution and people start burning the place down, and then we start afresh.
I'll leave it
eventually.
At that.
Not happy, but there we are. Normally, you're the one who's actually, finishes on the downer.
I'll leave you with the depressing note. That's about time we caught up.
There we are. We've turned tables. All right. Very good. That was very illuminating. Hopefully, people have got on board with that, and it makes perfect sense. I think we've tried to explain it as best we can. Illuminating as always, Steve. We'll catch you again next week.
Okay, mate. Bye.
And you know what? I think next week we should expand on this idea. I want to look at, the balance between private sector and public sector. If one goes up, does the other one necessarily go down? Is it by the same amount? And also just this idea, if we keep on adding bonds, if we keep on adding to government spending and they're issuing more and more bonds, what happens? Do we just accumulate masses of bonds, and what does that do for the private sector? Or does it balance itself out at some point? So I want to investigate all of that next time on the Debunking Economics podcast with Steve Keen. I'm Phil Dobbie. Catch you again next week. Thanks for listening.
The Debunking Economics podcast.
If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.